by records management, I mean, we should be able to have a record or to have a way of being able to show the interactions between one, I have seen a lot of business owners struggle with managing their businesses. And, I've also seen people who are educated, they're accountants, they have degrees, whatever. But when it comes to running their businesses, they forget the very basic item that's supposed to do, records management. And records don't have to be complicated. You don't have to have education in bookkeeping. You don't have to be a CPA. You don't have to have a degree in accounting. But records are important. And I have a few simple and basic ways that can help you maintain records for your business. Let me explain. As already said, the biggest reason why businesses fail is poor records management. And today, I want us to explain how to keep proper, simple, and what kind of records that a business should be kept. That should be kept by a business. Now, we've already explained in a previous lesson that the reasons why most other businesses fail is because there is no separation between the business and the owner. So in this case, I want us to go back to that concept a little bit, where we have you as the owner, we have the business as a separate entity, and we have the third parties again as a separate entity. So by records management, I mean, we should be able to have a record or to have a way of being able to show the interactions between one, the owner, and the business. Remember, these are two separate entities. How does the owner communicate or interact with the business? How should we record that kind of a transaction? Again, the business and third parties. We always, like in our learning, when you go to school to study your accounting, etc., we concentrate so much on the business transactions that involve the third parties, because this is where we have the customers, this is where we have the suppliers, this is where we have things like rent, things like employees, things that like transport that we pay to third parties, expenses. This is where we have the taxes that we pay to the government. So we concentrate so much with the business and the third parties. We know how to make a sales ledger. We know how to make a purchases ledger. We know how to calculate or account for expenses. We even know something about taxes. But when it comes to the owner and the business, we still forget that these are two entities and records for each should be kept, or records should be kept for them. So in today's lesson, I want us to briefly look at the 4 classes of records that every business should have, and that will help the business to be able to survive beyond the proverbial 2 years that most businesses fall within. And the first group of records is between you and the business, and by you, I mean the owner. The second category of records is the business assets. The third category is individual accounts. And the fourth is the bank accounts. not in any particular order, but I would want us to look briefly into each class and discuss how you can keep simple, basic records for that. Let's start with you and the business. Now, two simple things to note that, as we said earlier, when the owner supplies anything to the business, money, items, that should be recorded as capital. In other words, the business owes the owner what the owner has supplied to the business, that is capital. So it means, therefore, what the owner takes away from the business should also be recorded as either drawings or debt that the owner has borrowed from the business, and at a certain future date, they should repay that money, or the owner has simply taken things away from the business, and as such, those things should reduce their capital and hence their claim to the business and also their profits. So whenever you're putting up your ledgers, of course, I know a lot of people have the exercise book where you record your daily transactions, you record how many items you've sold, who owes you, what you've bought, what you've paid for your expenses. But now I'm asking you to also have another ledger where you keep records between you and the business. Record what you have taken to the business as your capital. Whatever you have invested in form of money to your business, whatever you've taken from home, maybe you had a personal car and then you converted it into a business car, that is part of capital. If you took furniture from your house, took them to the business, that is capital. Record all that. Then whatever you take from the business and you're not paying back. If you own a hotel and every day you take a cup of tea and a plate of whatever you cook, record that as drawings. If you take money from the cash register for personal use, record that as drawings. It's important, when you're stealing from the business, when you should stop, and when you should pay back. If you take huge amounts of money, again, that is debt by the owner to the business. Know that it's debt, and debt has to be repaid at a certain point in time, failure to which you will affect the cash flows of the business. If you affect the cash flows of the business, the operations will definitely go down, and you'll continue stealing from yourself, and the business might fail. So, number one, record between you and your business. Two, for your assets. We shall look at these more critically in the next lesson, but it's important to note that from our accounting equation, we said that business is defined by what it has, that is the assets. And these assets are the ones that generate the business income. But then again, we must also realize that these assets have a time limit. I mean, if you have a car, you can't stay with the car for 100 years. 5, 10 years maximum. If you have a computer, the same way. If you have furniture, 5, 10 years, it needs to be replaced. So after the time limit, it means replacement. And it's only after replacement that your cycle of having and running a business can be complete. That is, you have the assets, they generate the income, they reach their end of life, you replace them, so you have assets. So if at any one point you break this cycle by not replacing the asset, then that means you're breaking, or rather you are playing with the foundation of the business, which is the assets. And if you play with the foundation of the assets, of the business, you're counting days or months or years before the business fails. So by accounting for assets, it means we need to know each and every item, how much it's worth. We need to know how much time it has. Let's call it life. And we need to know how much to keep aside for replacement. This is basically our next lesson. So it's a full lesson, so make sure you watch the next video to understand this. And after you watch it, then that is where you'll understand why maybe some people, you go to a hotel, you knew it when it was new, but 10 years down the line, it's dilapidated, it's, on its way out, so there are no customers, etc. The reason is because they didn't follow through with the cycle of assets. And there's an accounting principle, there's an accounting treatment, we'll look at it. Then the next class of records to keep individual records. By individual, I mean every time the business has a transaction with a third party, then that transaction has to be recorded. And that is where we have things like journals and ledgers, trial balances, balance sheets, income and expenditure statements, cash flow statement, which you might think it's a bookkeeper's problem, but I will attach at the end of this video in the description an Excel sheet for those of you that are able to use the computers that will help you account or have a record for each and every transaction in your business on a daily basis. So that in the next phase of bookkeeping, that is analysis, you're able to know at the end of a certain period, how much sales did I make? How much purchases were there? If it's expenses, how much was my transport? How much was my airtime? How much did I pay to the casual laborers? How much did I pay for this and that? So that helps us in the individual account. Then last, but definitely not least, the bank accounts. Now, I'll state something that might take you a little time to understand, but when you conceptualize it, it will help you a lot in your businesses. That the best assistance that you have in your business is having a business bank account. To rephrase it, the best accounting tool that you can have for your business is your bank statement. So again, remember, you as the owner are separate from the business. You have your own personal bank account, but have a business bank account that operates specifically for the business. Then that must mean that all transactions, all business transactions go through your bank. You might say that, but there are bank charges and all that, but take that as the cost that you have to incur to have a bookkeeper. And this is how it works. When all your business transactions, remember, you and the owner, and you as the owner and the business, that's a transaction, the business and the third parties, that is a transaction. So every transaction, if it goes through the bank account, that means the bank statement, when you get it, it will indicate for you the date, the particulars, and the amount for every transaction. It will tell you that on 24th of August, the year that is 2024, you had sales. And to even be specific that you sold, if when you're depositing your sales amount, or if the buyer is paying through the bank, it will have the specifics of the customer. That is the particulars that you sold computers, or you sold these and these to customer A, and it will have an amount. Now, this will be repeated every day. There'll be a date, there'll be a particular, if it was rent, if it was whatever it is, then there'll be an amount. You might ask, what if I run a kibanda and I sell cereals? How does this help me? But if you're disciplined, at the end of every day, whatever sort of sales that you've collected, why not take them first through your bank account? Whenever you're paying expenses like rent, if you're paying yourself, if you're paying other expenses, why not again take them through the bank? And that might mean you having a checkbook. It might look odd, it might look big, it might look, not applicable, but that's what helps big businesses. When you hear them doing what we call bank reconciliation, they're basically going through the bank statement, trying to understand their accounts, trying to reconcile what actually happened and what the bank has recorded. But then, for smaller businesses, there's something else that can help you. Together with the bank accounts, also have a petty cash account. Petty cash, because you need small amounts for airtime, you need to move from point A to B. If you're buying goods from the market, you need to pay a carrier to, and you don't pay them with a check, you have to pay them with petty cash. But when you're withdrawing this amount, then it must first go through the bank. It means you wrote a check to yourself, you put the particulars as petty cash, and then at the end of the day, the amount that you withdrew for petty cash, it has to reconcile with all the expenses that you paid using that petty cash, whether it was airtime, whether it was transport, whether it was commissions for marketers, whether it was wages, whatever you paying through the petty cash, it has to be reconciled, but that petty cash has to go through the bank. So I'm not marketing any bank, but if you are a small business owner, if you're a business owner and you don't have a business bank account, you're missing out. If you're a business owner and you have not separated yourself from the business, you're stealing from yourself. So that is the records to keep for you to succeed in business. This is Basics of Business Management. This is Jeph Kafka TV. Until the next one, see you.